Good afternoon, everyone. It's Dave P. and RJ Pepino, and today is July 30th, 2021. This is the Cream Community Coaching Call. We're here every Friday, 4 p.m. Eastern, and you find the Zoom link within the Cream Community under Events on the left-hand side on the sidebar. So, RJ, I know you're in Florida right now, but still on the call. How are you?
I'm enjoying the sun. Consistent sun, and it's weird in Florida because it'll be storming for 45 minutes and then somehow the sun breaks through and becomes this tropical paradise. But it's been like this for several hours, so I don't think there's going to be another rain here in sight. So pretty excited.
Nice.
But getting some good quality time in with the family, and just grateful that I'm able to do this. Got a great team behind us, and we're able to enjoy this too. So
it's about
sometimes you got to enjoy creating magical moments, because that's what we're doing all of this for. And
yeah,
financial freedom is great to enjoy it.
It's all about creating memories, creating those magical
Mm-hmm.
moments, having the opportunity to do that. You're never gonna have this present moment ever again. And today's call, we are going to be getting into some exit strategies. And I've always been a huge proponent of knowing your exit strategy before you enter a deal. This is us as real estate investors. We should know what we are going to do with the property before we ever get involved and buy it. I think it's really important to have intention and put intention behind our business. And today we're talking about flipping exit strategies. So the flipping exit strategies we're going to be discussing is wholesale, retail, wholesale, and turnkey. These are flipping exit strategies that we have extensive experience in all four of them. There are other exit strategies that we're going to be doing on a different call, which will be a buy and hold exit strategy call, where we will be talking about the BRRRR method and doing regular leases, doing lease options, and we are going to be doing a call, including in there the Airbnb strategy, which RJ and I closed an Airbnb, which we're really excited about, and we're kind of entering that. It's a really hot thing to do. So that will be a future call. Today we're talking about flipping, and we're going to talk about the risks and rewards of each of the flipping exit strategies, and we're going to start with wholesale. So wholesaling properties is where you put the property into contract, and then you find you put it in contract with a seller, and then you find a buyer who's willing to pay more for that property, and then you assign them the contract where you are going to sell it for more than you're in contract for and make a fee. And we're going to kind of touch on the difference between assignments and double closings and kind of when to use both as well. So RJ, what are your 2 cents on the wholesaling exit strategy?
In the beginning, guys, you're going to want to buy wholesale a lot, and that's what you're going to need to do. We preach that you have to learn how to find the deals and negotiate the deals and make money. So, you're probably investing in a lot of mentoring and marketing right now. So, basically, if you are starting out, wholesaling is your best strategy, and then eventually you're going to run across deals that aren't going to be a big rehab, aren't going to really not need a lot of work to rent it out. And then we can talk about the renting out strategy, but in the beginning you need to get a big infusion of cash into your young business, and wholesaling allows you to do so because it's less risk. When you have there's already risks you're taking in starting this real estate entrepreneur journey. So you need to make money. So 10, 15, 20K hits, a couple of those each month, it's going to make you feel good and give you confidence to move forward. And so wholesaling is something that we still do today because we don't take on every house that we buy. Our marketing stretches out pretty wide. So a lot of leads come in that just doesn't fit our buy and hold model. So wholesaling allows us to make money on those type of leads.
And RJ, can you explain the difference between an assignment wholesale deal versus a double close wholesale?
Yeah, we do both in our company. If our assignment fee, so our typical assignment fee in our market's around 15K, 13 to 15K, right? If it's over a certain amount, if our buyer is going to see we're making more than 10,000, we as a company will double close. Let's just say our assignment fee is 20 or $30,000. Well, just from our experience, buyers tend to act a little funny when you're making that much money. Every buyer is going to say, "Oh, well, I don't really care." Like, we don't care what people, make on wholesale deals, as long as our number, makes sense. But at the same time, we're still looking at that number. We're like, internally as a company, we're like, wow, they found a smoking deal. How can we find smoking deals like that? So those are conversations that everyone's going to have, even if you're, um, you know, still getting a good deal on your end, you're like still looking at how can we create efficiencies and save money, right? So when a wholesale fee is over 10K, we'd like to double close. Just so you guys know, if you're running across a wholesale spread that big and you're having issues with your buyer, and you need transactional funding, we can help you. Just send us a message here in the platform, but we can help you transact that deal. Double closing is basically the act of taking the property down and immediately selling it to your end buyer. Or they call it like a concurrent closing, I think, in some areas. Basically, you take it down, you own it for an hour, you sell it back to your buyer, and then you make your spread. Now, it does cost you money because you have to pay some closing costs, recording costs, whatever it is. But sometimes it's necessary when you have a big spread. When it's a smaller spread and you need to stick to your guns and save that money, you can just assign it. You're just assigning the contract over to that end buyer, and they're going to see your fee. And they should be okay, but this is just an area of expertise that we have. How we've not to have these have to have a conversation with the buyer that's a little bit awkward. So that's how we operate with the wholesaling, and why we will assign some, double close others.
So the biggest thing that I'm hearing here, RJ, is when you're doing an assignment, the buyer and seller are going to see what you make on the deal, because there's only one closing and it's on that one settlement statement. When you are making a big spread, you might consider doing a double closing where there is going to be two closings, but the seller and buyer then are not going to see what you're making. So when we are making a pretty decent sized spread, and we like to play it safe and only do anything above 10K, we will do a double closing where we will close with our seller and then turn around and sell it to the buyer in the same exact day, same hour, just back-to-back closing. So we'll close with our seller and then we'll close with our buyer, two separate closings, so they do not see what you are making. But there is some added cost, but it prevents a buyer from getting cold feet or a seller from starting to question how much money you're making on this deal. So excellent job explaining that. And the next thing I want to do is a real quick one. It's pretty easy. It's retail. I'll take the reins on this one. A retail is when you are basically buying a property and you're going to sell it to somebody who's going to live there. You're selling it to a retail buyer. And a retail buyer, or somebody who's going to live in the property, will always pay the most. They'll always pay more than an investor will pay, because they're more emotionally charged in their buying decision. They're going to live there. They're already, picking out what colors they want to use. And, they're already moving into the property. They might want to raise their family there. An investor, when you sell to an investor with the wholesaling and model, investors are all about fundamentals. They really only care about how good of a deal they're getting on the property and how they're going to make money. And you got to leave meat on the bone. You can sell for much higher prices if you're selling to a retail buyer. And this is generally going to be property that you work with a realtor on, and maybe you have a realtor, or maybe you are a realtor, and they're going to put it on the open MLS market for you. And then buyers are going to probably end up using a loan, like a conventional or an FHA loan from a bank, that they're going to come and buy this property. They are willing to pay the most, but you do have to go through the nuances of potentially paying commission to your realtor. And, there's a little more picky buyers when it comes to the retail buyer, because, again, they're going to be living there. They're a little bit more emotionally charged. So, they might have some requests. They might have some requests for you to remedy some things, be a little bit more picky. The investor buyer in the wholesale model, they don't care. They know the property needs work. They're buying it as is. A retail buyer gives you the opportunity to make more because they're going to pay a higher price, but you have to go through the little nuances of maybe them being a little bit more picky, and then also the nuances of like having them to qualify for a loan. So you got to wait, then the house has got to get appraised. So there's a reward that you can sell it for more, but when you're dealing with a retail buyer, you do have to go through the motions, which could take a little bit longer than a cash buyer. RJ, anything to add to the retail flipping buyer model?
No, I think you nailed it right on the head. Yep.
That's probably the most common one that everyone can relate to, right? It's just a retail buyer, somebody who's going to live there. The next we want to talk about wholesale. So wholesale is a mixture of the wholesale and the retail. So RJ, what's wholesaling? How does that work?
Yeah, wholesaling is basically selling properties that you take down. You actually will close on it and do like a splash rehab. We call it splash rehab, just a complete trash out of the property, get all the items that were left over from the previous owner or the tenants, whatever the case may be. Maybe do a splash or a paint job around the interiors, and then you put it on the market to find somebody, a do-it-yourself home buyer, or a home buyer that's okay with the fixer-upper, slightly fixer-upper home. We're not going to do any updates to it. All we're going to do is just splash it up, put it on the MLS, and still make a good margin on it, because sometimes there's buyers that will pay close to retail, especially right now. You've got the supply and demand kind of issue where there's not a lot of supply right now, and obviously the housing demand is where it is. So people are looking for kind of slightly better deals on the MLS. So if a retail deal is selling for $200K, if we're going to wholesale it, we will probably get close to retail, but not really there. We'd probably, list it 20,000 under the retail prices, because retail prices is all fixed up. So on properties that don't need that much work, or even need a little bit of work, or even a ton of work, we're still able to take them down because we know that we have a good spread. But we know if we are going to wholesale to a cash buyer, they're going to want a discount. And there's a lot of buyers out there right now using loans, and or cash, and are okay with paying a little bit more with the shortage of inventory that's pretty much nationwide right now. So it's a good strategy to use when supply and demand are off balance.
Yeah,
like where it is right now.
Absolutely. It's a hot market out there. And wholesale, like we kind of talked about, is basically the mixture of wholesale and retail. And it's basically like selling a property that might need some work or might need some updating, but selling it to a retail buyer, but leaving a little meat on the bone. You're selling them, you're giving them a great deal, but it's basically like selling a do-it-yourself for property, like RJ mentioned, but selling it to a more retail-minded buyer who's probably going to buy it off the MLS or something like that. So the caveat with this one is you do need to take it down. And when RJ says take it down, he's talking about actually raising the private money and buying this property, and then doing the clean out and whatnot, and then selling it. So it allows us to sell to a retail-minded buyer and get a premium for it, but not have to do a ton of work. In a standard retail deal, obviously that buyer is going to be picky. They want the granite countertops. They want the new paint. They don't want to have to do any real work to it. They want it to be move-in ready. A wholesale is going to be one, maybe you do a little bit of work, but you're still giving a fair deal to the buyer, and they're going to kind of do it yourselfer. And that is the wholesale. So next is the turnkey model. The turnkey, not turkey. We were talking about the turnkey model. And this is mostly used when working, again, with investor. The buyer of a turnkey property is going to be an investor-minded buyer, but they are buying a property that is going to be, they want it to be fixed up and then rented out. So it's an investor buyer who is probably going to end up using a loan to buy the property. So it's not a cash buyer. Maybe sometimes it could be a cash buyer, but a lot of the turnkey deals that we have seen out there, the property has to be fixed up, has to be rented out because they're buying it based off the cash flow it produces. And then this buyer is most likely going to use financing for the property. And maybe, they want some property management in place. And this is very common. You see, investors in places like California where the prices are super high, contacting a company in the Midwest where the prices are lower. So they want to live in California, but invest where the cash flow is better. So they're going to be looking to purchase a property that's been fixed up and rented out and likely has management in place. So they're buying it as a cash flow play in a market that makes more sense. So RJ, what can you touch on here? And we got about 7 minutes before our hard stop, by the way.
The other three flipping models are obviously going to require you to raise private capital. And so if you're looking to do that and you need some extra help, we do have a course on private money, how to find it, the right paperwork, the right deal structure, what to ask, all that paperwork is there. So check out the training section and get the course. It's only $497. That investment in your education and be able to speak confidently in front of a private lender. You only need one private lender right now, and as because you need to build credibility. Once you get one going, that private lender can lead you to other of their friends who also want to get a better return on their money. So that private lending course is in our training. Definitely check it out. It's well worth your money.
So that is the 4 exit strategies when it comes to flipping real estate. And we'll just go through them real quickly here. Number 1, wholesaling. And wholesaling is either going to be in the form of an assignment or a double closing. When you do an assignment, just be cognizant of the fact that the buyer and seller are likely going to see what you're making on the property. So if you're making a lot, and we prefer over 10K to do a double closing where there is 2 closings, but nobody sees what you're making. Number 2 is the retail, self-explanatory. You're selling to a retail buyer who's likely going to live there, and that's where the property is fully fixed up. Number 3 is our wholesale, which is a mixture of the wholesale and retail, where you're basically selling a property that probably needs a little bit of work and giving the buyer a deal, but selling it to a retail-minded buyer who wants to fix it up themselves. They're willing to pay a little bit more than a wholesaler is willing to pay. And then finally, the turnkey business, the turnkey model, where the exit strategy is selling a property that is fixed up and rented out to an investor buyer who is going to buy this property based on the cash flow. And then maybe you'll offer management services as well, or you'll work with a local property manager. So that's it. We got about 4 minutes here. And RJ, I know Fidel in the community had a quick question regarding running comparables. I'll let you run with that here for a minute, and we'll put a bow on this thing.
Yeah, we're gonna need to use your screen because you got the computer screen, I got the phone. But the question is the property in Virginia. If you look at, I think it might have been your reminder. There's a property in there that he was looking for support on. Can you see it?
I'm pulling it up. A reminder, where would that be?
Did you send a group reminder, a message to the group?
Not today.
Okay.
Nope.
Okay.
Let me see.
Let me look for it here. I can't pull it up while I'm on my phone.
Where is that guy? Fidel, yes.
Yeah.
Okay. Help me. What's the ARV? I got the address here. And
it'll probably be easier to use. I mean, technically, we can use either PropStream or Zillow.
Yeah, that's what I'm pulling up, Zillow. And Fidel would like to know if he is correct in his assessment of this property, of the ARV being around 515,000. So it's 6511 Woodbrook Drive. And where my mind goes, everybody, I'll share my screen really quick. 6511 Woodbrook. I'll go right to Zillow. Okay, so we don't know, we haven't not seen pictures. Well, here's pictures of the house. I would go off Zillow's just Zestimate. It says 425. So Fidel's coming in a little bit higher at 515, but really this would be a great one to compare against other retail sales in the area. So if we can get access to the MLS, Fidel, if you can get access to the MLS, that's going to give a better, depiction of what other, you want to compare this one because it looks nice. I'm looking at the pictures right now. You want to compare it to other retail sales in the area for the ARV on this one. MLS is going to be your best bet on this one. 515 is quite a bit higher than 425. And I will share that Zillow's been decently accurate. They've gotten better over the years. So I might be a little careful, but I would look to the MLS. RJ, any?
You can look up, you can probably see the MLS, some of the MLS comps on PropStream. And PropStream will have pictures times.
RJ, you broke up a little bit there. Can't hear you, RJ. Okay, RJ, I think we lost audio here. Let us know if you can still hear us. But another thing I just wanted to show everybody is also just Google the address and look on realtor.com as well. Now, if this is also going to actually pretty close to the, so this one says 414, Zillow's saying 415. It's a little interesting. So another discrepancy here. Zillow has a rent Zestimate. The rent, I like to look at the rent Zestimate too of 2311, or this is 425. Realtor.com is saying 1780 on the rent Zestimate. So that, or the rental estimate. So pretty big discrepancy there, but the numbers are only about 10K off for that ARV. And, we don't know if these pictures are accurate. If they are, I really think, comparing this property to other retails is going to be the key. So it is 4:30. We do have a hard stop here today. And as I mentioned, we are going to be doing more exit strategy videos because we believe you should know your exit strategy before you ever enter a deal. And today we talked about the flipping exit strategies. And then the next time we do an exit strategy call, we will be talking about the buy and hold exit strategies, which is renting the property out, doing a rent to own, doing what is called a land contract, where you will basically be the bank for this person. And then also the Airbnb, will be touching on that as well for the buy and hold exit strategy. RJ, we got your back. Any closing words?
No, just make sure a lot of you guys are starting your wholesaling business right now. So just kind of focused on that. And then when you get you get a good understanding of what you kind of have to do with making sure that you get a lot of deals in your pipeline, then let's revisit some of these other exit strategies and let's help you. One thing at a time.
Start with the wholesaling. One thing at a time. Start with the wholesaling. It's the lowest risk strategy for you. And we will be with you every step of the way. This has been Dave P. and RJ with the Cream Community. It is July 30th, 2021, and we will see you on the next video.